everybody. Happy Tuesday. My name is DJ Wright. I'm a wealth advisor and portfolio manager for Financial Freedom Wealth Management Group. And I'm here for your Financial Tip Tuesday. So, tax season is here. And to get you all prepped, today we're going to talk about how your capital gains are taxed. So, capital gains result when somebody sells an investment for an amount greater than their purchase price. This could be a stock, it could be a mutual fund, an ETF, it could be a rental property, a lot of different things. It happens when you buy something, say at $10, it grows to $15, you sell it, it's a $5 gain. Note that this does not include anything you sell within a retirement account like a 401k or an IRA or a Roth IRA. Those are protected from taxes. So this would really just be for non-retirement accounts. Some people call them taxable accounts, non-qualified accounts, not inside of an IRA or 401k. So there's two kinds of gains. You've got short-term gains for investments held less than 1 year, and then you have long-term capital gains for investments held more than 1 year. And it's a huge difference on how these are taxed. So short-term capital gains are taxed at your ordinary income. So whatever, it's like you earned money from your W-2 wages. Whatever your tax bracket is, that's what you pay. And again, that's short-term, held less than 1 year. Long-term capital gains are taxed at capital gains tax rates, which have much better tax treatment than ordinary income rates. There's three brackets. It's a lot simpler too. You have 0%, 15%, and 20%. So it's really important for you to know how long you've held an investment, because if you held it for 11 months versus just over 12 months, huge difference in how that's taxed. So make sure that you are aware. If you have capital losses and capital gains from two different investments, could be two stocks, could be a stock and a mutual fund, just a mix and match of two different or more investments, the gains and losses can be used to offset each other. So let's say that you owned a stock, you sold it for a $5,000 gain. 6 months later, you had a mutual fund that you then sold for a $5,000 loss. You could actually use those two to offset each other. Your net taxable income would be nothing, right? The gains and losses offset. If your losses exceed the gains, so you offset the gains and losses and you still have losses left over, you can actually use 3,000 of those to offset regular income. So this could be like your W-2 wages, right? You can use 3,000 and deduct that and save some money there. If after that you still have losses left over, they can generally be carried on to future years. So it's not all lost, right? Nobody wants to have a loss on an investment, but it can happen, and there is a silver lining in that you get to use that to deduct taxes in future years. So again, they offset each other. 3,000 can be used to offset regular income. If you still have something left over, that can be carried to offset future taxable gains. So with the recent market pullback that we've seen, this can be a good time to look at any non-retirement taxable accounts to see if you should be making any changes. You can sell things for less gains than you could several months ago. And so if there was something that you were wanting to make a change in your account, or you needed to reposition some things, it could be a good time to do that and save some money on taxes. Now, there's a lot that goes into that and evaluating if it makes sense for you, but something to look at. So if you have an account, you want some help, we'd be happy to take a look at your portfolio and go over your options and see if it is, does make sense to make some changes. Um, Let us know if there's anything we can do. I hope you all have a wonderful week, and be safe out there. Thanks.